Hi there, welcome once again to the Dukascopy TV studio here in Geneva. I'm Ben Jones. Patrizio Merciai is back alongside me to take a look at the markets. Patrizio, once again, thank you very much for joining us.
My pleasure, thank you.
So you've stated that one should forget the ECB and watch the Fed. Why is this?
Oh, well, you know, if we backtrack for a moment, you know, a few days ago, in Europe especially, it was back to school, back to work, and people wanted to hear nice stories, you know. And we had the ECB meeting, you know, the ECB announcement earlier in September, with new stimulus being announced. And this obviously the markets took it very positively, and it was everyone was euphoric. You had bond yields falling again. You had the euro falling versus the dollar, which is usually good for confidence in Europe. A lot of good things happening. And then markets, investors realized that maybe the ECB had promised a few things, but maybe they will not be doing as much as expected. And then they are looking at calendars and they see, my God, there's a Fed meeting coming. And maybe what the ECB will give in terms of extra liquidity on one hand will be taken away by the Fed on the other hand, because the Fed has to worry about growth and the impact on interest rates. So the ECB may be still easy, but the Fed will be less and less so. So back to reality, back to work, back to the working period of the year, and let's look at the Fed.
Yes, looking at the Fed, for what period of time do you think they will pause?
Yeah, you know, the big question is Mrs. Yellen, Janet Yellen, has provided a lot of guidance about pausing between the moment where, you know, they are now almost finished tapering, i.e. they are stopping purchasing assets, purchasing bonds. So the extra stimulus is coming down to zero. And then they will have to withdraw part of that stimulus and to raise rates. But between those 2 points in time, there will be a pause. Now the question is, how long, as you said? And the market has been expecting something between 9 and 12 months. If we assume that tapering will be finished in October, it would mean rates will start being hiked up in the third quarter, in July or something. Now maybe the market is watching the Fed, watching at the economic data and thinking, let's wait for a minute. Growth is there, inflation is not worrisome, but it's there as well. And the Fed has to put things back to normal. So the pause could be shorter. And probably the market is moving now, and that's also my opinion, to something around 6 months, meaning end of tapering October, and probably the very first moves of rates up and of bringing down once again the balance sheet of the Fed, something by the end of the second quarter. So a bit shorter pause than was initially expected.
Okay, now moving on, I'd like to discuss the relationship between commodity prices and Chinese demand. Can you discuss how these two are linked, and in what does one have more influence over the other?
Yeah, that's an interesting question, because actually it's a bit of a chicken and egg situation. Okay, you could say everyone has noticed, you know, commodities have been very weak in the last weeks, and you can say, okay, part of it is due to disappointing growth in China. Data releases over last weekend were quite weak, or at least by Chinese standards, not weak by international standards. And so you could say, okay, less demand in China, meaning commodity prices coming down. But you could also view that from the opposite side, meaning that okay, China is not really a competitive economy yet, meaning that if commodity prices go up, producers in China can push the prices, can pass those higher prices through to their consumers. If prices are a bit weaker, they would say, oh my God, we cannot raise prices ourselves, so maybe we will have less profits, so maybe we should invest less. So you could argue that lower world commodity prices also have at least a short-term impact on capital spending in China. Capital spending in China has been disappointing, but it's probably a pause. But it means that, okay, you have a kind of chicken and egg situation. You have a kind of, and you can see the correlation between the two measures, meaning, okay, commodities are weak or commodity prices are soft, so we are in China, there is a bit less of capital spending, so as long as it's less capital spending, investors in commodities will push the prices down again. So I think it's a transitory phase because the Chinese economy is still growing, a bit below par, but it's still growing. But at this point, I would say there is still downward pressure on commodities because of China.
Okay, and finally, if you can discuss, do you see the euro getting dramatically lower, like some expect?
Well, we are a bit back to the ECB versus the Fed. You know, when the ECB moved, everyone pushed the euro down, saying, "Okay, this is it." You know, ECB is really stimulative, and the Fed will be a bit tougher. So the two economic policies, the two monetary policies will diverge. So let's sell the euro. I think this is already in the price, you know, and now the euro is a bit stabilizing. I would expect it to stay around, you know, that 130, 129, 130 range, consolidating a bit. It has consolidated already. Ultimately, I think it can go lower. It can go to maybe 126 or thereabout. But I think really the big move is done. And now investors have a more sober view of economic policies and the growth outlook. So I would expect the euro to pause, to make a kind of plateau before the next step.
Patrizio, once again, it's a pleasure having you in the studio.
My pleasure, thank you.
And thank you for watching. Do make sure you keep clicking back to Dukascopy TV, as we'll be bringing you plenty more updates and exclusive interviews. Bye for now.